Chapter 2. In Chapter 2, you're going to learn about individual account records of increases and decreases in specific accounts, like assets, liabilities, or owner's equity. Debits is really the left side, credit is really the right side, but debits is the act of entering an amount on the left side of an account. It's called debiting the account. When comparing totals of two sides, an account shows a debit balance if the total debit amounts exceeds the total credits. Credits indicates the right side of the account. The account of entering amounts on the right side of an account is called crediting account. When a company comparing totals of two sides, an account shows a credit balance if the credit amount exceeds the debit amounts. Basically have a double entry system. Each transaction must affect two or more accounts to keep the basic accounting equation in balance. Debits must equal to credits. Uh, this slide is showing the normal balances for debits and credit balances. So assets and owner's equity, owner's drawings, dividends, expenses, losses. Uh, those are normally debit balances. For credit balances, liabilities, owner's capital, stockholders' equity, revenues, and gains, those are typically credit balances. Chapter 2 is going to get into journals. Companies, they initially record transactions in chronological order. So a journal is referred to as the book of original entry. Um, let's see. Companies make separate journal entries for each transaction. Companies complete journal entry consists of the date of the transaction, the accounts, and the amounts to be debited and credited. All right. The ledger includes the entire group of accounts maintained by the company. A trial balance is a list of the accounts and the balances at a specific time. This is generally prepared at the end of an accounting period, like December 31st or June 30th or whatever it should be. Accounts are listed in the order in which they appear in the ledger. Debit balances appear on the left column and credit balances appear in the right column. The trial balances does not provide the company, it does not prove the company has recorded all its transactions or that the ledger is correct. In order to prepare the trial balance, you have to list the account balances in the appropriate debit or credit columns, and you have to total the debit and the credit columns, and you have to prove that those two columns equal. Real quick, I'm going to step you through quick demonstration of some chapter 2 problems you may encounter. Um, I spoke about this in chapter 1, but it's just basically a walkthrough of journal journal entries and journal form and how they look on T accounts because it's a focus on what's on the left, debits, what's on the right, credits. And so I won't walk through this again, but see chapter 1, a presentation as we walk through that during that. Another example you're going to see, and it's filled out for us already here, kind of helping us out. But in exercise 2.4, the following information is related to this real estate agency. On October 1st, Mr. Bramble begins a business as a real estate agent with cash investments of 21,900. What does it look like when somebody puts a cash investment into a new business? First transaction. Anybody know? Well, he has cash, so he's gonna debit the cash to the business because they have a cash bank balance now, 21,900, and he's gonna credit owner's capital. That increases. Now he has a stockholders equity, owner's capital, and he has cash of 21,900. The equation balances. On October 2nd, he wants and hires an administrative assistant. Okay, is any money in and out for that? In that alone, no. So there's no effect. There's no journal entry being made here. So you see that effect right here. For October 3rd, it looks like some money is going to be moved around when he purchases office furniture for $2,700, and he did it on account. He didn't use cash. He did it on a business credit card or something. So it's on account. So purchases, debit is going to increase to equipment because now he has office furniture as equipment for 2,700, and he didn't lose cash, but he has accounts payable now since he still owes that 2,700. So a credit to accounts payable, that's going to increase liabilities. Do you understand what's happening here? All right. On the 6th, he sells a house and a lot for C. Rouse. He bills C. Rouse 5,200 for realty services performed. So he hasn't received the cash, so he's owed a receivable. That's going to debit the receivable by 5,200. So it's going to be an increasing asset. And he provided a service, so it's going to increase the revenues and credit service revenue by the 5,200. All right. We're almost done here, but on the 27th, he pays 1,600 on the balance for what he owed on the 3rd. So the 2,700, he pays a little bit, 1,600. So on the 27th, cash is going to decrease because he pays 1,600, and accounts payable is going to decrease, and then the decrease to accounts payable is a debit because the normal balance of accounts payable is a credit. So a debit of 1,600 to accounts payable, credit to cash because you're reducing cash by credit. And last but not least, on October 30th, that assistant that they hired earlier, they finally decide they're going to pay him 3,600 in salary for that month of October. So you're paying, so cash is going to decrease by credit. You see cash is decreasing, and you have to recognize an expense of salaries, wages to the admin assistant by debiting expense in the income statement. So I just want to walk you through this quick example. You're going to see something very similar like that in your Wiley homework. But if you have any questions, let me know. Thank you for your time. Bye.